This is Lecture 9, Accounts Receivable. We've seen accounts receivable before. So let's take a look at a typical company's accounts receivable. Let's say that they have $500 of receivables. Now, we have been assuming to this point that all of those receivables will be collected. But the reality is that not everyone is able to pay their bills. Sometimes customers may have disputes and not want to pay their bill. Right? What we know is that in the real world, it's very likely that some of these receivables will not be collected. Okay? Now, I don't know exactly how much won't be collected, but maybe I've been in the business a while. Maybe I can make a good guess. So let's say that I'm guessing that $30 of accounts receivable will not be collected. So that means that I really think that $470 will be collected. Right? So I'm guessing 30 will not, so 470 will. Okay, so which value for accounts receivable should I show on my balance sheet? Should I show 500 or should I show 470? All right, well, 470 is more conservative. Remember, with conservatism, we do not want to overstate assets. So if we use 500, we're probably overstating the value of the receivables because we're not actually going to collect that much value out of them. So 470 is more conservative. 470 is also a more realistic number. That's what we're much more likely to get. So GAAP says that we have to use, GAAP says that we have to use the 470. Okay. All right, so this $30 is something we call the allowance for credit losses. So credit losses are uncollectible accounts receivable. In general, it could mean any receivable, but specifically for this class, we're going to use credit losses to refer to uncollectible accounts receivable. Allowance means money or something put aside, right? Like if somebody's having issues and you say, I'm making allowances for you, right? That's the meaning of the word allowance that we're using here. So we're putting something aside, an allowance for credit losses. That is, losses from the receivables that cannot be collected. All right, and then down here at the bottom, we have accounts receivable net. And you remember we used that word net before, right? It means after something has been subtracted. So we're going to subtract the allowance from the accounts receivable. All right, where did we see this kind of setup before? Where we had the accounts receivable or something, and then we subtracted something, and then we got a net. Yeah, we saw that with the accumulated depreciation, right? So we saw that before with the accumulated depreciation, and that's the same idea again. The allowance for credit losses is a contra account, just like the accumulated depreciation was. In this case, the allowance is a contra account to the accounts receivable. Okay, now let's say that we start out with a company who has $100 of accounts receivable, and they expect that $5 of those receivables will not be collected, which means that they have 95 left. I don't know, I think this is getting a little too technical. Let's make it a little more fun. Let's say that I have a bag of Skittles. And of course, Skittles come in all different flavors. And I really like Skittles, but I don't like the green ones so much, right? For whatever reason, the green ones just not my thing. So let's say I have a bag and I know the bag tells me there are 100 Skittles in the bag. Now, I know that there are some green ones in there. I don't know how many, but I'm going to make a guess. I think there are 5 green ones in the bag. That means that there are 95 pieces of candy that I actually want to eat. Now, I'm a picky, weird person, so I like to sort my Skittles into their colors so I can eat all the flavors, separately. So I can like have all the cherry ones and all the grape ones and whatever. So let's say I start sorting out my Skittles, and as I'm doing that, I'm taking out the green ones and I'm kind of throwing them away. So I start looking through this bag and I find a green one. And what do? I toss it away, right? Maybe I give it to my friend who likes green ones. All right, so how many Skittles do I have left? Well, I started out with 100, so now I have 99 left, right? Now, I had estimated that there were 5 green ones in the bag. So how many green ones do I think there are now? Well, now that I've located one, right, I think that there are 4 green ones left. So how many good pieces of candy that I actually like, how many of those are left? Well, it's still 95. Now let's say I keep going. I'm still looking through that candy. I want to find those green ones and get them out and sort all the rest of them. So I keep going through and I find another green one. So I give that one over to my friend who's going to eat it. Now, how many pieces of candy do I have left? Well, I've got 98 left because I just gave one away. How many more green ones do I think are in the pile? Right? Well, I think there are 3 left. All right, so how many total pieces of candy that are there left that I want to eat? Well, that's still 95. Okay. All right, so what's happening here? I am sorting through these 100 pieces of candy, right? And I am trying to find the ones that are bad and get rid of them. Okay? So as I find the ones that are undesirable, I get rid of them. That lowers my total amount and it lowers the amount that I estimate is left. But you notice the entire time, the total is still the same. Now that is going to be the case always. And that's how it works for accounts receivable, right? I'm talking about candy, but there is a job called accounts receivable clerk. So imagine the accounts receivable clerk is going through a big pile of receivables and trying to find the good receivables. So they're searching through all these receivables and they know some of them won't be collected, right? But eventually they find them, right? And when they do, they remove them. Okay, so when we remove the bad receivables, the total accounts receivable goes down, but our estimate of the bad ones also goes down. So the good receivables, our estimate of the good amount stays the same. Okay. All right, so in accounting, this is what we call a write-off. Now, a write-off in general means the removal of an account from the accounting records. Could be anything. If we take something in the accounting records and it doesn't have value anymore and we get rid of it, that is called a write-off. Okay? So we are using it specifically here to talk about uncollectible accounts receivable. But accountants will use that term write-off for other things as well. Essentially, we're removing some item from the records because it's not worth anything anymore. Okay. All right, so what we do is we start with a certain amount of receivables. We estimate how many we can't collect. and then we have our total that we think we will collect, right? But that means that in the future, when we do find the ones that are bad, we've already taken the hit. We've already taken out this 5. So the bottom line, right, the total valuable receivables, that does not change because we've already removed the bad ones, so the amount of good ones are still there. Okay, now this can be difficult to do in the real world. The problem is that we don't know which receivables are uncollectible until they actually end up being uncollectible. Right? If I have a store and someone comes into my store, is there a little sign over their head that says, I won't pay my bills? Obviously not, right? We don't actually know who is not going to pay their bills. If we did know, we wouldn't sell to those people, right? We'd only sell to the people who are actually going to pay us. But we don't know, so we sell to everybody, and that means that we have to run this risk of not collecting receivables, right? So this 5 here is a total guess. I don't actually know the people who won't pay. I don't actually know for sure that it's going to be $5. Just like if I open a bag of Skittles, I don't actually know for sure that there are 5 green ones in there. I'm just making a guess based on my past history, based on my past experiences. So it's not a sure number, but it's the best guess that I can make. So imagine that we do this at December 31st. We set up the receivables and we estimate how much we cannot collect. Then the following year, as we run our business, as we try to collect our receivables, we actually identify those people who won't pay. And when we find those people who won't pay, we do a write-off. We remove their receivable from the accounting records. Now, the journal entry to do that is we are going to decrease both the allowance and the accounts receivable, right? So we're decreasing the receivables, right? We can see that here in this top line. And we're also decreasing the allowance. So receivables decreasing, that's a credit because it's an asset. The allowance decreasing is a debit because it's a contra account. Remember, it works opposite from the receivables. So since this is a debit because it's an asset, that means the allowance is a credit, so debit is decreasing it. Okay, so that's essentially how receivables work. Is we estimate at year end how much we think we will not collect. And then the following year, as we actually find out the people who won't collect, who won't pay us, then we do the write-offs. So the only thing I haven't shown you is how do we get this $5 here in the first place? What do we actually have to do? So at year end, we make an adjusting journal entry to update the allowance. And that adjusting journal entry debits credit loss expense, right? So we're debiting an expense for credit losses, right? So we're debiting an expense for the people who don't pay us. And then here we're crediting or setting up this allowance for credit losses. So we do this adjusting entry at the end of the year, and then the following year, as we discover people who can't pay, we do this write-off entry. Okay, I know this is all kind of theoretical, so let's do an example. So we'll start with example 1. On January 1st, 2020, Elk Company had $20 in the allowance for credit losses. During 2020, $12 of receivables were discovered to be uncollectible and written off. Okay, so we're going to give Elk's journal entry to record those write-offs for the year. All right, so the write-offs are going to decrease both the allowance and the accounts receivable. So we're going to debit or decrease the allowance for the $12 of write-offs, right? The $12 given in the question. And then we're going to decrease the receivables as well. Now let's take a look at the T account for the allowance for credit losses. Now, it says in the question that on January 1st, they had $20 in the allowance. We know that's a credit because remember, it's a contra account to the accounts receivable. So this is going to be a debit, the allowance is going to be a credit. So we know it starts with a credit. Now we have debited or decreased the allowance by $12. That means we have 8 left. Now this is for the entire year. So the amount of write-offs is not the same as the allowance that we set up way back at the previous year doing this. That's pretty realistic because remember, this allowance here is a guess. We are guessing how much will not be collected. We don't actually know. Just like when I open a bag of Skittles, I don't actually know how many green ones are in there. I am guessing. It's entirely possible that my guess is wrong. I may guess too high. I may guess too low. Realistically, my guess is probably at least a little bit off, right? I might be very close, but in the real world, it's hard to guess the number exactly. So we usually end up with a situation like this for most companies, where in this case, they guessed $20, the actual thing was 12. Now that's good for the company because they guessed they wouldn't collect 20, but it was only 12 they couldn't collect, so they did better than they thought. That means, however, that we have an $8 leftover. Now, in this case, the leftovers over here on the credit side, it's entirely possible the leftover could be here. What if I guessed 20, but the amount I couldn't get was actually 22, right? Then I'd have a leftover here on the debit side. So the leftover could be on either side, could be anywhere. But in this case, it happens to be on the credit side. Right? My point here is that there's usually some kind of leftover. Usually the amount we guessed last year and the actual write-offs are different. Okay. All right, let's move on with the question. At December 31st, 2020, Elk had accounts receivable of $1,200. Elk estimates that 2% of the accounts receivable are uncollectible. So we're going to record Elk's credit loss expense for the year and calculate their ending balance in the allowance. Okay, now I said that at the end of the year we do this journal entry. We're going to do this journal entry for this company in Part B. But how do we get the number? How do we figure out the amount that we don't think we're going to collect? Well, there are 2 different ways to do that. And the first way is what's mentioned in the question. It's called the percentage of receivables method. So the percentage of receivables method, we call this a balance sheet approach, and I'll explain why in just a minute. The percentage of receivables method says that a percentage of receivables is the allowance balance. And that's what we see right here in the question. Elk estimates that 2% of the accounts receivable, right, the percentage of receivables, are uncollectible. All right, well, what are the accounts receivable that are uncollectible, right? Well, that is the definition of the allowance. The allowance is the amount of accounts receivable the company does not expect to collect, right? So that is the allowance. So that's what we see here. The percentage of receivables, in this case 2%, are the amount they cannot collect, the allowance. Okay, so let's do that calculation. We know that 2% of the receivables, and the receivables are $1,200, cannot be collected. So we've determined that 24 is the allowance balance. So the allowance balance is our estimate of the amount that cannot be collected. All right, so let's take a look. Before, we had this in our T account, right? So now what we're saying is we think that the total in the allowance should be 24 at the end of the year. Right now, though, it's 8. So we are going to have to adjust the allowance T account to make sure that we get a total of 24 at the bottom. All right, so we had $8 that was left over from before. We know that we want the total to be 24. So in order for it to be 24, we're going to have to credit the allowance for 16. So we're going to do a journal entry that credits the allowance for 16. And the debit is credit loss expense. So we are crediting the allowance for 16, right? It's blue here because it's this number here. This is the credit. We've determined we need 16 to get our desired total of 24. So we're crediting the allowance 16, and that debit goes to an expense, credit loss expense. So this is our adjusting entry at the end of the year, right? It's the same structure, what I showed you up here. Right? So this is our adjusting entry. This will bring the allowance to $24, which is what we want it to be to start next year. Okay, so that's the basics of how it works. But this is a very simplistic version of it. I just said, hey, they estimate 2% of all the receivables can't be collected. The thing is, though, when companies have a lot of accounts receivable, they usually don't have them all as one big lump like this. Usually what happens is a company will divide their accounts receivable into age groups. Okay. So let's take a look at part C. So C is ignoring part B. So let's pretend B didn't happen. Instead, at December 31st, Elk still has $1,200 of receivables, but they have broken them down now into age categories. And these age categories are less than 30 days old, 30 to 60 days old, 61 to 90 days, and greater than 90 days. Okay, so what do I mean if I say a receivable is less than 30 days old? I mean that it has been less than 30 days since the day the receivable was created, right? Since its birth, essentially. So since the day that the customer came in and I performed services and they did not pay, right? It has been less than 30 days since that time. Now you'll notice these age groups are in increments of 30 days. That's because 30 days is roughly 1 month. So we like to do it with 30-day increments because then we're saying, okay, less than a month, 1 to 2 months, 2 to 3 months, more than 3 months, right? So we're able to break it down. All right. Why would a company do this? Why would a company go to all this work to break down their receivables by age? Well, the answer is that the older the receivable gets, the less likely we are to collect it. Right? So that's just, general common sense. If a receivable gets older and older and older, we feel less and less confident about eventually collecting that money. If someone has owed me money for a week, I feel pretty good, yeah, I'm going to get that back. But suppose that person has owed me money for a month or 3 months or 6 months. Right? The longer it takes, right, the less likely we feel like we are to get that money. And after a certain amount of time, we just eliminate it completely. It's been a year, this guy hasn't paid me, he's not going to pay me, right? So eventually at some point we say, hey, this person's not going to pay, and we do a write-off. But in general, the older the receivable, the less likely we think we are to collect. Now that's helpful in 2 ways. First, if I'm the accounts receivable clerk and I'm looking through the receivables and I'm trying to find out who's not going to pay, I know where to focus, right? I'm going to focus on these ones that are much older, right, in these categories. And if I'm going to start calling up people and maybe pushing them a little, hey, you need to pay your bill, I'm going to go call these people. I'm not going to call the guy who purchased something last week, right? I'm going to go call the guy who purchased something 3 months ago and has ignored us ever since, right? So this is where I'm going to focus my collection efforts. Okay, the other way that it's helpful is here with the amount that we're estimating cannot be collected. Obviously, the older the receivable gets, the higher the percentage until we get here to 20% when it's over 3 months. Okay, so if companies have a lot of receivables, chances are they don't just have one lump $1,200. Chances are pretty good that they're actually breaking them down into these age groups. Okay, so let's do the question again, right? We're still going to use the same technique. We're going to say that the percentage of receivables is the allowance balance. But the difference is that the percentage of receivables, instead of just now being one number times 1%, we're going to have 4 numbers times 4%. So we're going to multiply this out. So in the less than 30 days category, we'll take our $800, multiply by the 1% we think we can't collect to get $8, right? In 30 to 60 days, 250 times 2% is $5. In 61 to 90, $100 times 5% is $5. And then more than 3 months, $50 times 20% is $10. So we have a total of $28 we can't collect. Now, of course, that 28, that is our percentage of receivables. So that's what we think will be the allowance balance. All right, so previously we had our, less complicated estimate. We said 24. In this example, we're ignoring that. We're saying, let's get more specific, break it down more carefully. Now we're guessing 28 will not be collected. All right, so in the allowance T account, what's going to happen? Let's put that all on one page. All right, so if you remember, previously in A, we ended up with $8 after the write-offs. Now we're saying, hey, 28 will not be collected. So here's our 28 here. In fact, let me highlight that so we can see where it's going. So that 28 is not going to be collected, but that means we need $20 to make the allowance what we want it to be. And we'll do that in our journal entry. We're going to credit the allowance. Credit, we see right here, right, $20. And then the debit goes to credit loss expense. So you can imagine that every year, this is what happens, right? At the end of the year, we figure out how much we need in the allowance. We figure out the amount of expense that we have to record, and we set that up. And then the following year, we discover who will actually not pay, and we record the write-offs. So let's keep on with that. Let's see what happens the following year. So let's say company did this, what we saw in Part C. Now here in D, during 2021, Elk wrote off $30 of accounts receivable, and we're going to give the journal entry for those write-offs. All right, so what's the write-off again? The write-off is when we remove the receivables we can't collect. So we're going to decrease both the receivables and the allowance. So we're going to debit the allowance and credit accounts receivable, $30, right? So in the allowance T account, let's take a look here. So at the end of the previous year, we had 28, right? Remember that from there. And now we are decreasing the allowance by $30. Oops, there it is. So we're debiting the allowance by 30 because that's what we couldn't collect. And here it is. Now, at the end of the previous year, we estimated that 28 would not be collected, right? That's what we did over here. We estimated we're not going to collect 28. We were close, but we weren't quite right. The actual amount we couldn't collect was 30. So we have a leftover of 2 here on the debit side, right? So that's what we have in the account before we get to the year end and we have to do our adjusting entry again. Okay, now there is another way to estimate the amount in the allowance, to estimate how much expense we record. So let's take a look at that other method here in E. So continuing on from C and D, during 2021, Elk had revenues of $7,200. Elk estimates that 0.5%, that's a 0.5% of revenues, will result in credit loss expense. Okay, so we're going to do the same thing. We're going to record that adjusting journal entry and calculate the ending amount in the allowance. But we're doing it in a slightly different way this time. We're doing the percentage of revenues method. Okay, so what we've got here is we have a percentage of revenues. We're estimating 0.5% of revenues, and that will result in credit loss expense. So we're saying a percentage of revenues is going to be our credit loss expense. All right, so calculating that out, that means that we think 0.5% or 0.005, right, is going to be our percentage multiplied by the revenues of $7,200, and that gives $36, which is our credit loss expense, right? That's what we said right here. It's our credit loss expense. Okay, where do we use the credit loss expense? Well, the only thing we've used the credit loss expense in is the journal entry. So what we're going to do is take that $36 and record it as credit loss expense. Right? So this $36 is going to be recorded here in the journal entry. Now, because we're debiting the credit loss expense by $36, the other side of the entry, the allowance, that means it will be credited for $36. So if I look in my T account, keep building on the same T account here, right? We had $2 left over, right? That's what we saw at the end of the previous question. And now we're saying that we are going to credit the allowance for 36. And here we see that $36 credit. So that means our total allowance is 34. Okay, if you're confused right now, I'm not surprised, because what I just showed you right here, that's the opposite of what I was doing over here. All right, so let me explain what's going on. What's going on is we have 2 different methods. The first method we have is the percentage of receivables method. That focuses on receivables. The accounts receivable are on the balance sheet. So what we're doing here with this method is we're saying, let's look at the balance sheet, let's look at our accounts receivable and estimate what amount of them cannot be collected. So we're using the receivables on the balance sheet and we're using that to calculate the allowance, its contra account, which is also on the balance sheet. That's why this is called, way back here, I said it was a balance sheet approach, because we're using receivables on the balance sheet to calculate the allowance on the balance sheet. Now, over here, we're using the percentage of revenue method, and the percentage of revenue method is an income statement approach. Instead of looking at the balance sheet and the receivables, we're looking at the income statement and we say, hey, we've got all these revenues, but some of those revenues we're not actually going to collect the money. And that's going to be an expense for us, a credit loss expense. So we're looking at the income statement and we're using revenues on the income statement to calculate the expense on the income statement. So we're taking the two income statement items together, the revenues and the expenses. With the balance sheet approach, what we do up here, we're taking the receivables on the balance sheet and we're using that to calculate the allowance, its contra account on the balance sheet. So this is the balance sheet approach because we're using two balance sheet items, one balance sheet item to calculate another balance sheet item. And this is the income statement approach because we're using two income statement items, one income statement item to calculate another income statement item. Okay, so ultimately, what does this come down to? We need two things. Question E and question C both ask for the same thing. They want the credit loss expense and the ending amount in the allowance. Right? In C, I wanted the same stuff. Right? I wanted the credit loss expense and the ending balance in the allowance. Those are the two things we need to know. So let's take a look at it here. Right? We need the credit loss expense. That's this number because this is the number that goes in the journal entry and that's what becomes the expense. So this number is the amount of expense that gets recorded. And this number is the ending balance in the allowance. In both cases, we're calculating these two numbers, right? In this question, I'm calculating these two numbers. The question is, which one do I calculate first? And it matters because we have mathematically a difference. If I calculate this number first, I'm going to get one set of results. And if I calculate this number first, I'm going to get a different set of results. Right? If you're into math, the reason that it matters is because we have a leftover. Right? If I were perfectly guessing every time, it wouldn't matter. But because we always have these little leftovers, it's going to make a difference which one we calculate first. So over here, with the percentage of receivables method, I calculate the allowance balance. So I'm calculating this bottom number first. And then based on what I want this to be, I know how much I need to record here in the journal entry. But with the percentage of revenues method, with my income statement approach, I'm calculating this number first, right? I'm calculating the amount in the journal entry first. And based on that, that tells me what my total is going to be in the allowance. So am I calculating this number first, the expense, or am I calculating this number first, the allowance balance, the total? Okay. That's the difference between the two methods. Now, I know it's confusing to have two different methods that are backwards from each other. So why am I teaching you both of these? Well, the answer is both methods are allowed under the GAAP rules. And it's about a 50-50 split. Companies can choose either method, and about half of companies choose percentage of receivables, and about half of them choose percentage of revenues. So you are likely to encounter both of these in the real world. So some companies are all focused on the balance sheet and they'll use percentage of receivables, and some are focused on the income statement and they'll use percentage of revenues. And you just have to be able to deal with it. So that's why I'm teaching you both ways. Some companies use one, some companies use the other. Both are allowed under the accounting rules. The reason that both are allowed, the reason that the rules don't just say use this and be done with it, is because one is based on the balance sheet and one is based on the income statement. If we were to pick one method over the other, we'd be saying this financial statement is more important than the other. So can I say the income statement is more important than the balance sheet? Can I say, hey, the balance sheet is more important than the income statement? As a general rule, no. For an individual company, yes, we might be able to do that. And that's how they pick which method they want to use, right? Do I want the balance sheet method? Do I want the income statement method? But overall, in the general rules, we can't make that statement. So that's why both methods are allowed, because companies are allowed to pick the one that works best for them. Okay, now I know that was a whole lot of stuff. That's essentially the meat of what we are learning today. I'm going to go through another example and go through this all again from scratch, identifying the two methods and how it all works. Just before I get to that though, there is one more little piece that I want to cover. Okay? So remember with the percentage of receivables method, I first said, okay, let's just take a percentage of the total receivables. And then I said, that's not realistic. Most companies will break down receivables by age. Okay? So the same is true for the income statement method. Here I just said, let's take a percentage of all the revenues. Most companies will actually break it down a little further because most companies don't just sell to customers on account. They also sell to customers in cash. So let's say that I have some revenues that were generated with cash payments from customers, and I have some revenues that were generated by customers who paid on account. Now, the customers who pay in cash, do I have any problem collecting from them? No, right? If everybody paid in cash, this whole lecture would be irrelevant, right? We wouldn't have to worry about receivables or not collecting these things. It would not be an issue. So if customers pay in cash, we have no problems with credit losses, no problems with uncollectability. The only time we're going to need an allowance, that we're going to have a risk of not collecting, is if the customer pays on account. So some companies will use the percentage of revenues method, but they'll only look at revenues on account. So that's what we have here in part F. All right, so let's look at the last possibility. So ignoring this one here in E, let's go with this. Let's say that in 2021, Elk had $7,200 of total revenues, of which $4,500 were cash revenues, right? And $2,700 were revenues on account. So it's still $7,200 of revenues, but now we're breaking it up into cash and on account. Elk estimates that 1% of all revenues on account will result in credit loss expense. So again, we're going to do the two things. We're going to record their credit loss expense and calculate their ending balance in the allowance. Okay, so this is exactly what we did before, right? We're still having percentage of revenues because we're still taking a percentage of revenues, right? It's revenues on account, but it's still a percentage of revenues. So we're still using this method, but now we're only going to use the revenues on account. So we are going to take 1% of the revenues on account, which are $2,700, and that's going to give us $27, which will be our credit loss expense. All right, so we're going to take that $27 and we're going to record it in a journal entry. So we're going to debit the credit loss expense for $27, and then the credit goes to the allowance. So in the T account, previously we had determined that there was a $2 left over at the end of the year, and now we're learning that we're crediting the allowance for $27. So we see that here. So that means that that means that we're going to have a total in the allowance of $25. Okay. All right, so that is the two different methods, right? We have percentage of receivables and percentage of revenues. So what I would like to do now is start on a fresh example. We're going to put it on a fresh page too. We're going to go all the way down here and put in a fresh example. And we're going to cover this material all over again. All right, so let's look at this one. Now you'll notice there's a lot of information here, but this is going to be kind of a kitchen sink problem. We're going to look at this from every possible way. So what does this have? Gold Corporation has the following data. Okay, they have gross accounts receivable. What does gross mean again? Remember, gross is the whole amount. It's not the net amount, it's the whole amount. So this means without the allowance, right? Gross accounts receivable is the total receivables without any subtractions, so without the allowance. Okay, so the total receivables are $1,400, and that's broken up into two age categories. We have less than 2 months old and more than 2 months old. Okay. Now, the allowance for credit losses at December 31st is a credit of $35. So this is the leftover that we have in the account before recording the credit loss expense. So before our adjusting entry, there is a credit of $35 in the account. And we have revenues for the year, and those revenues are $6,250. Of those revenues, some of them were in cash and some of them were on account. Now, I'm going to give you 4 independent situations, so 4 different possibilities for how Gold could treat their receivables. And for each one, we're going to calculate their credit loss expense and the balance in the allowance. Okay? Okay, so let's look at the first situation. The first situation is A. All right, so Gold estimates that 0.5%, that's a 0.5% of all revenues, will result in credit loss expense. Okay, when you get a receivables question, whether it's in the homework, whether it's on the test, whether it's anywhere else, the first thing you need to do is determine which method are they using. Are they using percentage of receivables or percentage of revenues? Okay, so in this question, which method are they using? Well, it's pretty clear that they're using percentage of revenues because it says right here, 0.5% of all revenues. It's percentage of revenues. Now, hopefully that was pretty easy to figure out. All questions will be that easy because in the question, I'm going to give you a percentage, but I can't just say, oh, it's 1%. Well, 1% of what, right? You need more detail. So every time you're given a percentage, it tells you it's a percentage of something. And as long as you're paying attention, as long as you're looking for that percentage of, it's going to tell you what it's a percentage of. In this case, revenues. So we're using the percentage of revenues method. So it's easy to figure out the method. What you have to do is remember to look for the method. And that's where I find most students fall apart. They forget to look for the method and they just assume, oh, it's this way because that's how I did it before. You have to make sure, is this the method you did before or is it the other method, right? So in this case, percentage of revenues. Okay, so we know it's the percentage of revenues method. So mathematically, we're going to calculate that percentage of revenues and it's going to equal something. Now, what is it going to calculate? And this is the tough part here, right? What am I going to calculate? Well, the way that you remember that is you remember that those two methods, percentage of receivables and percentage of revenues, one is a balance sheet method and one is an income statement method. So here we have revenues. Which financial statement do revenues appear on? The balance sheet or the income statement? Well, they're on the income statement. So we're using the income statement method. So that means the thing we're calculating here, that is going to be something else on the income statement. So we're using revenues on the income statement to calculate something else on the income statement. Okay, so what's on the income statement besides revenues? Expenses. So we are calculating the credit loss expense. So the way that we know that is because revenues and expenses go together on the income statement. So you know that you're calculating the expense. All right, so let's calculate 0.5% of the revenues. Now I wrote this out in decimals because I know sometimes people have difficulty with the decimal percentages and the actual decimal. 0.5% is 0.005 for your calculator. Okay? And we're going to multiply that by all revenues, which are $6,250. and that's going to give us $31.25. So we're going to make a journal entry here where we debit the credit loss expense, right? And we debit it for the $31.25, and then we credit the allowance for $31.25. So in the T account, we started out with $35. Remember that credit of $35 that was given in the question. And we know now that we're crediting the allowance for $31.25, so the total amount is $36.25. All right, let's try that again, but this time we're going to use a new situation. So let's take a look at situation B. Gold estimates that 1% of all accounts receivable less than 61 days old and 7% of all accounts receivable more than 60 days old will eventually prove to be uncollectible. Okay, that's a lot more words. It sounds a lot more complicated, but we're going to approach this in the exact same way. First things first, which method is being used? Well, it's percentage of receivables, right? 1% of accounts receivable. Okay? And over here, 7% of accounts receivable. So it's pretty clear that we're going to be taking percentages of accounts receivable. So that means we're using the percentage of receivables method. Okay, but what are we calculating? Receivables are on which financial statement? We see the accounts receivable on the balance sheet. So that means this is the balance sheet approach. So we're going to use the receivables to calculate something else on the balance sheet. Okay, so what else goes on the balance sheet that relates to this uncollectible stuff? Well, the answer is the allowance, right? The receivables own contra account. That's also on the balance sheet. So we are calculating the allowance balance. So that's the key to reconstructing the formula, right? The revenues calculate the expense, both on the income statement, and the receivables calculate the allowance, both on the balance sheet. So that's how we can reconstruct the formula, right? I know it's really easy if you're just trying to memorize to get that, but if you remember the income statement items go together, revenues and expenses, and the balance sheet items go together, the receivables and their contra account, the allowance, right? That makes it easier. Okay, so let's do the calculation. So here we have 1% of the receivables less than 61 days old. So 1% of 950, right? You see that here. And 7% of the receivables more than 60 days old. So 7% of 450, and we'll see that here. If we add those together, we get $41. So we know that our allowance balance, the total in the allowance, is going to be $41. All right, now let's put that in the T account. We know from the question that before we do our adjustment, right, that the allowance for credit losses has a $35 credit in it, right? That was given in the problem here. All right, so we have $35 in it, and we know the total has to be 41, so we can see that right here. Okay. All right, then that means we need a $6 credit to get from the 35 we've got to the 41 we want. So that $6 credit is going to be part of our adjusting journal entry. We're going to credit the allowance, and the debit goes to credit loss expense of $6. Okay, let's try it again with a new situation. So remember, the procedure is determine the method, use that method to determine the formula, then calculate the number, and then apply that number to the thing you have calculated, right? All right, so let's do that again. First, we're going to determine the method here. Gold estimates that 4% of all accounts receivable will never be collected. So that's clearly percentage of receivables. Okay? So we know that we're going to have a percentage of receivables. And what does that percentage of receivables calculate? Well, receivables are on the balance sheet, so it calculates something else on the balance sheet, which is the allowance balance. Okay. So let's do the math. We have 4%, right, of all accounts receivable. And all accounts receivable in the question are $1,400. So we have 4% of $1,400, which is $56. Okay, so first step was figure out the method. Second step was determine the formula based on the method. And the third step here is going to be to take that number we've calculated and apply it to the right thing. All right, what's the right thing? Well, we've calculated the allowance balance. So we're going to apply it to the allowance balance, the total in the allowance T account. Okay, so let's look at the allowance T account. We know that there's $35 in there before we do anything, and we've calculated that the allowance balance is $56. So that means that we need $21 in our journal entry to adjust. So our journal entry is going to credit the allowance and for 21, and the debit will go to credit loss expense. Okay, last one here. So D. Gold estimates that 1% of all revenues on account will result in credit loss expense. Okay, step one, which method is it? Well, it's 1% of all revenues. So it's pretty clear it's percentage of revenues. Okay, step two, figure out the formula. Well, it's percentage of revenues. So what are we going to calculate here? Well, revenues are on the income statement, so we're going to calculate something else on the income statement. We're going to calculate the expense, revenues and expense, both on the income statement. So we're calculating the credit loss expense. Now, let's calculate the actual numbers involved. So we have in this question 1% of all revenues. So we've got 1% times the total revenues, $62.50. So let's put that here in the question. Oh, no, I'm sorry. I made a mistake. It's not all revenues on account. Ooh, let's read the whole question. 1% of the revenues on account, which is $37.50. Okay, so. All right, so we've got 1% of $37.50, which is $37.50. All right, now, last step. We're going to take that $37.50 and apply it to the thing we've calculated. Now, we've calculated the credit loss expense, so we're going to apply this as credit loss expense, which means in the journal entry, we are going to debit credit loss expense by $37.50. Okay, and then that means the allowance is credited to $37.50. All right, so therefore, in the T account, we started out the year, or this adjustment, with $35 in here, and we are crediting the allowance for $37.50, so that means the total allowance is $72.50. Okay. All right, let's just do one more little thing here. So let's look at E here. For part D, what is net accounts receivable? Okay, so this is back to the very beginning of the class. What was the net accounts receivable? Well, the net accounts receivable is the accounts receivable minus the allowance. So for part D, the accounts receivable in total are $1,400, And we know that because back here, the total accounts receivable are $1,400. So we have $1,400 less the allowance that we calculated in Part D of $7,250. So the total accounts receivable net are $1,327.50. Okay, so I know this has been a lot of heavy material today, so we're going to end it here, and I'll give you some homework, which is due on Thursday. So this will help you practice on the receivables. So we have 3 questions, 2, 3, and 4. I'll give you a hint. They're all very similar, right? So they all pretty much set up in a similar way, but you have to check the method that they're asking for and then use that method to calculate the credit loss expense and the allowance for credit losses, right? So those all have to be there. Okay, here's one more hint. We have a test coming up shortly. When you go to study for that test, I want you to go over this question again. And I want you to make sure that you understand what's going on in each of these examples and why each one is different and how each of the 2 methods is applied throughout the example. If you do that, you're going to be in pretty good shape to talk about receivables on the test. Okay? So these questions here for homework will help you practice on that. So that will be due Thursday. Okay, next time we're just going to discuss a bunch of little topics, some fluffier things that deal with current assets. And until then, stay healthy.